The purpose of the new legislation is to modernise and simplify the law as it relates to companies in Ireland. What I want to do in this segment is to specifically look at the duties and liabilities of directors within the new law. What the new Companies Act has done is to codify and set out what are the duties and liabilities of directors. There are now statutory duties which a director has got to comply with. The duties of a director are to act in good faith in what the director considers to be the interests of the company, to act honestly and responsibly in relation to the conduct of the affairs of the company, to act in accordance with the company's constitution and exercise his or her powers only for the purposes allowed by law, not to use the company's property, information or opportunities for his or her or anyone else's benefit unless approved by members or in the company's constitution. Now, this is an important one, and it could give rise to questions going forward, such as, am I allowed use a company phone? Am I allowed use a company vehicle? And they're things that directors will have to look at and consider. Another duty is not to agree to restrict a director's powers, though this can be done if it's permitted by the Constitution or by the members. Another duty is to avoid any conflict between the director's duties to the company and the director's other interests. A director has a duty to exercise care, skill, and diligence. A director must have regard to the interests of the company's employees in general and to the interests of the company's members, the shareholders. The legislation creates new duties and liabilities for directors. Importantly, there's now a duty to appoint a company secretary with the skills necessary to discharge his or her statutory duties, which, to my mind, means that proper resources have to be provided. There's a duty to prepare and deliver a Section 19 constitution where circumstances require it. There's a duty now on directors to prepare a compliance statement where appropriate. So, for example, if a company has a balance sheet in excess of €12.5 million and turnover in excess of €25 million, compliance statements will be required. Importantly, the duties of directors are owed to the company. A company can sue a director for breach of duty. Another important aspect would be loans by directors to a company and loans by a company to its directors. Loans by directors to companies come in many guises, including start-up costs, deferred salary, purchase of assets, payment of debts, deferred expenses, and the list goes on. All loans by directors to companies should now be in writing. If a loan is not in writing, there is a rebuttable presumption that the loan is a gift to the company by the director. If it is shown that the loan is not a gift, then there is a rebuttable presumption that the loan is unsecured and does not bear interest. These are matters which will be of interest to auditors, the revenue commissioners, liquidators and the ODCE. Loans by a company to its directors need to be considered carefully as well. Loans to directors in breach of statutory limits are the most commonly reported offence to the Office of the Director of Corporate Enforcement. All loans by a company to a director should now be in writing. If a loan to a director is not evidenced in writing, there is a rebuttable presumption that interest should be charged on it. If a loan to a director is not evidenced in writing, there is a rebuttable presumption that it is repayable on demand.